It's time for our energy update with Dan McTeague, president of Canadians for Affordable Energy.
We have seen from the Department of Energy, the U.S. Department of Energy, the weekly inventory report, oil production and oil inventories dropped almost 7 million barrels. Normally, that would mean a bullish sign that would cause prices to go back up. That's not happening. And it's good news for consumers because markets are going out of their way to ignore deliberately the fundamentals of economics, of supply and demand. And what that really means is that we have seen just in the past week alone what has amounted to about a 5 cent a liter decrease, something I wouldn't have seen at this time of year, certainly not for another couple of weeks. But if we go from coast to coast, Vancouver down to $1.73, Alberta down to $1.45 on average. We look to Saskatchewan moving to 148, so down a couple of pennies. Manitoba down in the 132, 133 range. Ontario, $1.46, $1.47, $1.48 this weekend. With Quebec, about 10 cents a liter higher. And even the Maritimes have been enjoying what has been a 4 to 5 cent a liter drop down on average into the 150s and low 160s. What this really indicates is that the market is completely run by hedge funds. I say that not as an insult, but they are clearly not demonstrating a resilience to what is happening on global signals. It's good to talk about slowdowns and potential economic news around the world, especially China, but demand remains robust and supply, as I indicated, is actually dwindling. OPEC is not going to drop its production quotas. It's going to continue that for the next couple of months anyways, until the end of the year. And so we're hearing from various groups, Reuters, Goldman Sachs, that say, yeah, oil's still going to go down. What they're not saying is that they support the Democrats in the United States, and that's pretty much an indication of what they're really trying to do. Having had experience for several years working for an American company doing American gasoline in my former jobs with Gas Buddy, it's not lost on me that Americans are extraordinarily sensitive to gas prices. So these hedge funds that have a political angle don't want to hurt the party that they're supporting, that is the Democrats, with higher oil prices. So what they're doing is artificially dumbing down the price because they take very strong, massive positions in oil. And it's caused a lot of frustration from those who are experts, who know this business very well, and are scratching their head, actually beyond that, pulling out their hair. And, incredulous that the world is continuing to ignore significant signs of drawdown, not just among OPEC nations, but if you look at it, this week's and last week's and next week's possible inventory report are going to show a pretty significant drop. The United States right now is about 5% below its normal average oil capacity for this time of year. And that kind of inventory number is a stark reminder that we may be heading into a bit of an energy crisis. I would say a global energy crunch, because we are ignoring what is extremely important. These lower prices, and that we welcome them, will only further demand, while not addressing the issue of fundamental supply. Teresa, last week, ExxonMobil put out a report. BP used to do this, many other countries have done this, many other companies have done this, not for their own interest, but saying for every barrel of oil that we're using today, only half of that is being replaced by new discoveries and investments. So it's going to get pretty ugly at some point. I don't know when that's going to be. I would think, if the election's over in November, the dust has settled, then we'll see where this lands. But I can tell you, with the United States having to repurchase a lot of the oil into its strategic petroleum reserve, with OPEC maintaining its production cuts until the end of the year, and with a global energy market run by hedge funds that are extremely dysfunctional and highly partisan, I can't see how this is going to end well for consumers, especially when governments find more increasing trendy ways to lard on more taxes, as we're seeing with not just the increase in carbon taxes, but the clean fuel standard, the second carbon tax. Now, of course, the other factor for Canadians is the value of the Canadian dollar, which has remained about 135 pennies to buy $1. Just to put that in perspective, that costs you and I an extra 21 cents a liter right across the country, no matter where you are. That's including HST or GST. So when you think about it, higher taxes and a weak Canadian dollar probably contributes about 50 cents a liter additional cost for everybody. Imagine what it's doing for other commodities, which are all priced in U.S. terms, whether we make them here in Canada or not. I can't leave without talking a little bit about EVs. It looks like the EV situation is beginning to disintegrate. Every company that's out there is now saying no more to EVs, no more investments. They're not accepting the grift. that has significant implications for the automotive sector and for the future energy use. That's it for this week. Let's talk midweek when we talk about the switch back from summer to winter gasoline, which will bring with it a 6 cent a litre net decrease in gasoline prices across Canada.